Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. On this show, we do a deep dive into the alternative investment space, share industry leader insights, and discuss the latest innovations in technology. Today, we'll start with my Market Pulse snapshot, and I'll share the one thing that caught my attention this week in private markets. Next, John Dean of AXA IM Alts joins me in the studio to discuss impact investing. And then we'll answer your question of the month with iCapital's head of private market research, Kunal Shah. Let's get to it. In today's Market Pulse snapshot, the one thing I'm focused on is whether after years of excitement, the ESG investing trend is starting to wane. Should investors still allocate to these strategies or should they look elsewhere? Well, first, let's draw the distinction between all the various terms out there: ESG, sustainability, impact investing. ESG strategies are typically public market strategies that incorporate the environmental, social, and governance considerations into their investment decision-making process. Now, they may invest in clean energy or electric vehicle companies, but not only so. They also focus more broadly on companies that score highly on their ESG practices. Now, for example, this might include a tech firm that is buying renewable energy credits, or another one that is building their data centers in Iceland to reduce the amount of cooling that is otherwise needed for the heat generation of servers. Now, in contrast, sustainability or impact investing specifically focuses on companies that help move the needle on certain issues by providing technologies like decarbonization, circular economy, certain access to healthcare, and more. This type of investment is mostly done in private markets. For example, there's 6 times as many private renewable energy companies globally versus public, or 55 times as many private companies working on carbon capture technology versus public. Now, what's interesting today is the shifting investor preference between the two types of strategies. ESG fund flows have notably weakened after the surge that we've seen in 2021. They've slowed down to a trickle by the end of last year. That could be due to recent underperformance. In 2023, the median ESG fund, proxied by 129 US ESG ETFs within the Bloomberg universe, had a total return of just 16% versus 26% for the S&P 500. However, inflows into the private sustainable investing funds have actually continued. For example, AgTech, CleanTech, Climate Tech, and broadly impact investing funds have collectively raised a record $100 billion in 2023, which is up 45% from 2022 levels and 70% higher than the prior 5-year annual average. And these fund verticals have delivered strong returns since inception through today. Median IRRs for 2010 through 2019 vintages range from 12% to 21%. Now, I think this divergence is telling, and I think it's set to continue. One thing to note, the overlap between ESG fund holdings and non-ESG fund holdings is seemingly increasing. The top 5 assets held by ESG ETFs include Microsoft, Apple, Alphabet, Nvidia, and First Solar, with 4 of those also being the top holdings in the S&P 500 and the NASDAQ. Now, in my opinion, more and more managers will integrate ESG considerations into the portfolio decision-making process, but does that necessarily need to be done in distinct ESG funds? Maybe not. On the flip side, private markets are incubating the next generation of technology that can help tackle sustainability issues. Now, many of these companies are experiencing faster revenue and earnings growth than what's available in broad public markets, and this is what should drive the potential for above-market returns. As long as these private market managers deliver both purpose and profits for investors, we think that the private market sustainable investments are attractive and should continue to grow. And that's your one thing in private markets this week.